All right. A couple pointers, things you want to do intraday. Let's say, we all know that spreads generally were created for swing trades, right? So, look at a 4 hour chart and most people will swing trade for many months, strongest versus weakest pair. But especially when you're doing a calendar spread, it's very hard to make money on a calendar spread. Again, once the calendar spread, it's just one market, the same market just spread over different months, right? So time spread, people call them calendar spread or whatnot. And you're going to get your biggest moves in intermarket spreads. They obviously cost more. The moves can take you out quicker, but that's where usually the plays are. And you want to come down into the smaller time frame. One of the things that we get a little too hung up on and used to, and I did this for a long time before I went back to mostly intraday, is I'd get caught up in one of the same pairs. It just becomes like this. Wheat versus corn became this big thing for us one summer. We were trading it like every day in our old group, and it did have its moves, but that was just its time. A lot of the time, what happens is one of these markets is just not doing anything at all, and the other one is just moving. So it's kind of like just like mirroring what the outright market is doing versus the other one that's stagnant. Let's see in this example here, this white line is corn. It just hasn't done much. And wheat sold off, wheat came back in, and all this is really portraying here on this spread at the bottom of this screen is really just what wheat is doing, right? It's like, you're kind of really not getting anything out of corn except paying an extra commission each way in and out, kind of a waste. Really, the spread is not doing much, really, right? Because, again, look at corn, it's at a, it's not moving relative to wheat. So kind of just, you got that. So one thing you can do, which I notice some of you guys are pretty sharp at doing, is you're finding the further away markets and you're trying to time a convergence from the divergence in. And we're just very smart because what's going to happen at least is you're going to get a mover. So if you see soybean here in this kind of light blue or whatever, and then the standard blue is wheat, let's come down here and change this up. Move this mic out of my way. So we got wheat. I'm just going to put on continuous, right? Versus soybean. And what you're going to have is wheat minus soybean. You're going to get a market that actually can give you some good swing for the day. Even then, I mean, look, it's you miss a move most of the time in these kind of spread, you're done for the day. I mean, you got to just take a continuation trade, because if you try to time a reversion, you're not going to probably catch it intraday. Look at this time here. This was spent from the 19th on Monday all the way through the day. Didn't get much. So the moves too, you got to pick your pairs wisely for short time frame, because again, remember, these spreads are not really made for intraday, although we've kind of manipulated them to do it. And it's not there's markets that just, like those equity spreads will move, right? So I think like once a week or once every 10 business days, you'll get punked out of that one, right? You'll get chopped up, and on the spread itself, you'll kind of feel like a waste of time. But again, nothing's perfect. And even then, sometimes what it does is it doesn't allow you to blow out. It might just keep you at a small loser or small winner. You drain your whole day on this kind of an NQES spread, like probably like something like today, where that market's been really tight because of the, minutes that are coming up here. About 20 minutes from the time I recorded this, I'm recording here. So anyway, what you can do is find these opportunity, and hopefully you catch it at the right time. Like this was early yesterday morning. We went long wheat versus corn, and it stayed that way. So what gets tough is sometimes finding these pullback entries. And what the Supertrend really does is it's that visualization. It's that, because we're using ATR logic inside of Supertrend, it helps to find a good continuation price. You want to continue with the price. You don't want to overpay, hop in a trade, and then you're in there for a day, 2 days, and not making crap. Although this continuation did continue on the long side, here on this 15-minute chart, you'd be still doing well. But, you know, and in fact, because the multiplier on these is the same, at about 50 a point, you'd be up, about, 10 points or so from this area up here, right? If I'm not mistaken here, 601593, yeah. More or less, 10 points or so. So you gotta kind of just be a little unique and find them, and find a good entry to come in, find a good time frame to look at. Perhaps come down, like I said, intraday. You're looking at 5 minutes. It's just, it gets a little noisy, and also indicator wise too. You just kind of don't know what to do. This thing's been sideways since yesterday, also as well. See, so they're far apart from each other. But yet, they have, where are they at now again? Where'd they go? It got away from me. Obviously, although they've been away from each other, since Tuesday is where, that big play was, right? And then we've kind of just been sideways. So kind of just got to play around. And let me move this now into like, energies, for example, and take a look here. Like we got, nat gas, and this is usually the common thing for the season. Nat gas is always the most uncorrelated to the other energies, so you want to find yourself maybe doing like crude versus like heating oil or something like that. Do a 1-to-1 crack spread, just little ideas. But again, if they're too tight, you might not make anything worth your time intraday. But you got something kind of here. Let's go down to a 5 minute here. This is crude versus heating oil, which is diesel. And this is as of Wednesday at 7 a.m. And you had crude long and heating oil short, right? And here at the top, sometime on TradingView, these aren't pretty, by the way. There's always a little compromise to these. You got crude is in the white, and heating oil is here in this yellow, and you can see where they opened up together, and they usually will do this. You can catch them at like the 8 o'clock crude pit open, 30 minutes before equities. You go catch something at the energy open. Usually they'll kind of get like this, like a one way. Like if we look at here at crude, you can clearly see on the outright, that was one way. If we were able to put that on HO, heating oil, which I'm not going to do at the moment, then you'll clearly see, you had a really good spread there. So you got to get creative. A little bit of research is, involved in this, but you go long crude, short heating oil. Your Supertrend is just confirming your direction. Pullbacks near them is usually the wisest thing to do, is to take. So again, and that's why I say, guys, like on the auto trader, it really didn't come out the way I wanted it. Our developer and I broke ties because I think he was kind of I'm not going to slander and say anything, but, so until the day we get someone that can continue a code that he made, a lot of guys in C#, they don't like taking over other people's codes. To some of them, it just looks like spaghetti. So again, we're using it as visualization because for years, the way I trade it is manually, right? I'm looking for the best entry. Once the trend takes place, I'm looking for pullbacks. Again, why is Supertrend a really good indicator to me? And I've used it in many other systems and models, at least visually, because it's dynamic. And intraday, even like, trading auction market theory and stuff like that, it's dynamic. Trading our algos, we come down here and we have the VQS, which is a trend trading algo, real basic. Why do we always suggest guys use, the ATR for that moment, okay, as your, where you would suggest a stop. Some people want to be static, want a 10 tick stop on crude. We had a young female that bought this a while back. She said, no matter what, I want 10 tick stop, 10 tick reward. She wanted a 1R. You won't last like that, in this business, because it's just not a true thing. That's static. Dynamically right now at this moment, crude's at 16 ticks, on ATR. You'd want to be going, and I'm jumping across the table here a little bit, guys, but you risk 16 ticks. Where's that like RR thing I got here? Is it here? No, is it this? Let's say like, you risk 16 ticks, to make, you go 2R. one of the things that we talk about all the time is manually, when we set up the VQS, which again, this is a full range VQS chart. I got them on all the markets. We got them on ES, for example. We have our regular 5-minute chart. We'll have a little footprint to look at, and I connect that into my auction market theory. But we're slightly to the short side, sideways, slightly to the short side, and this would be an 8-range ES VQS chart. So it'd be taking shorts if we're shorts only. And again, how do we measure where we're going to really get? It's dynamically, right? We're only batting 4 points on the ES right now. You're not really getting enough move to most likely even get 8 points. Our total range, our opening range and everything on ES, it's total range is like 12 points. So you can, it may fulfill that, but you definitely on tight days can go 1R. Some people want to scalp. You can go 1R on tight days. You're going to risk 4 to get 4. That's fine. Some people will trade 2 lots, 3 lots. Like earlier this morning, I was just drilling this out, and you're gonna get a pretty hefty, return. Again, you gotta know what you're dealing with. So that's VQS chart right there. So that's our Viper VQS. I don't have the spreader on this workspace, particularly keep them separate. But back to that ATR talk, Supertrend is ATR based, and this is why I like it for pullbacks, because it's an average range pullback, right? And that's, market moving in fractals is a good fractal area. Go long, long, hey, you missed it. Now always your third, fourth attempt, you're higher risk, right? This would have been much risky to take end of the day, especially with on crude oil, they're got another hour left on their market. Is there going to be a full turn? Riskier later you get in the day, but these are spots where you find your pullback reentries. So again, back to now the spreads. So you have a 1-to-1 crack spread here, crude versus heating oil. You have the whole energy market up here at the top, so you can stare and kind of analyze and see what you think you want to. Let's look here at indices. So obviously, it would have been easier just staying short. And this was from Europe. We had another trader already did his micro equity trading during Europe. Pretty much just all day. Again, being so kind of sideways, but to the short side again, as we discussed, NQ weaker than ES, right? And you can see that here. This little blue kind of aqua color is NQ, and ES being the blue line, kind of sideways. With today's kind of just one of them days. Like I said, in 5 minutes you have FOMC, but I think the bigger thing is going to be Nvidia stock post cash hours, and it's going to be a mover. So I think it's just really holding these markets up. But again, it's irrelevant to a spreader. If you caught any site weakness, NQ is weaker than ES. Why? ES is just not doing as much. NQ is more slightly to the downside. We can see that on individual charts here when you just take a look. It's just NQ's been a little bit weaker than its cousin, right? So you have more sideways action, ES, more short action, NQ. And what you're going to get as a result is on the spread, you're going to get that NQ weaker versus ES kind of a thing, which normally typically is not the case. Intraday it can happen, it'll do it, but over a swing time, obviously you'll see most of the time tech is leading the herd usually, for the most case, at least over S&P. If we separate small caps and Dow, then you'll usually see that, the leader is usually tech. There's been a little change in the ways market's been going to go out macro, like on a macro level, right? Normally, tech is the one that's outperforming on the S&P. And of course, I think since last year, we've had a big increase in small caps outperforming. And one of the things you got to watch out with TradingView is just the way the data comes in. It's not as good as other chart platforms, unfortunately. It moves around real funky. You got to really set this in and bring it in. As soon as you move it, you'll get a lot of this stuff. And this is probably because of not having like historical tick data in here. You can't get this thing to hold. But it's okay. It does the job. And you can kind of see, again, weakness in NQ since even last week, right? So you'd look for these pullbacks, and you trade these in or out, I mean. And that's how you do that. Yeah, so back to grains. Let's take one more last look at grains. I know you guys had a little more question on that. Actually, let's go here, grains, and then let's move this over to what I'm going to do here on this. What I'd like to do. Say you wanted to do, March versus December. And obviously the wider out you go, the more price expansion you're going to get on a calendar spread. So these things trend a lot. What you want to probably do is come in, these would be a swing trade. And again, we just haven't found, these spreads have just been shit since like all this Ukraine stuff. All these commodity funds and traders are completely been short these grains. But I think the reason and why it is we went out of norm. People were wondering why and stuff like that. Let me just go to a continuous chart real quick here. Don't forget that we were in super extremes because freaking this whole Ukraine thing. So I believe, what we've been doing is just coming back into norms. So it's been really hard for swing trade spreaders to find their seasonalities. Why is seasonality all jacked? Well, it's all jacked because we've been out of norm. We've been way out there. And these guys are just shorting the heck out of this to bring this finally back in. That's a sign maybe geopolitically there's something that's going to stabilize soon. They know about that. We don't. I don't know. They tie this a lot to this Ukraine stuff, wheat and corn and all that. We have farming people here that are having their own issues. I say that these are the norms normally, and we were just in extremes, and they're trying to bring that thing back down. So until then, it's going to be hard to find. A lot of people are saying they're having a hard time finding long spreads. And what could happen potentially is, people getting blown out right now, or into a lot of trouble because these grains are just they've been out there and they need to come back in. And so I think anyone that's been swing trading these should have been short with all the funds rather than trying to take long seasonality view that the seasonalities just don't work all the time because this is not seasonality is not adjusted for this crap. Now there is a project that Dan Scar at Scar Charts is working on that's going to adjust seasonality by volatility. Again, why do I love vol? When someone talks vol, it's dynamic. And I don't think I have the right to show the preview of that yet. The guy's working on it. But what will happen is that their seasonality charts will be dynamically adjusted with vol. And there will be opportunities to find re-entry longs in a market that is way out of whack and is coming in because funds are selling the crap out of them to bring them back in. That's kind of just my opinion, my thoughts on it. Want to throw that out there. So you want to be careful when you're trading these calendar spreads in markets like grains because they're just not in their norm. Okay, but normally what you do is chart it up, macro too. If you want to, do this on a macro time frame, corn versus wheat. Let's do it the other way. Wheat versus corn. This is just where it went out of whack. So now you can find these places where there was longs, because these are the norms here. If you see, I think this zero line is it's like true parity. Let's just do wheat versus corn because that's been like the normal thing we do around here. Wheat versus corn, so we can look at it in the way that we've been so used to looking at it. But when you pull this thing in, these are the abnormalities, and these are your normal ranges. So, could we find possibly towards the end of the summer a good place to go long wheat, short corn? Probably right around June or July. That's its tendency too, by the way, because the new crop, old crop, farmers are selling their stuff off usually by June, July. They're through their harvest, planting, and now they're ready to start selling. Okay, who are they selling to? They're selling to speculators. Speculators are buying, they're selling all the way up. That's how it works. And they're looking to cash in. Both sides are looking to cash in. They're hedging their product. Speculators are making money. So now we've kind of looked like we're coming into these norm areas, but we're in the middle of nothing, right? So you got to just be smart about these. You got to analyze these just like you would look at any kind of single instrument. They're kind of like they're living in their own world of their own, and so that's something you want to be mindful for too. What else would I like to share? Otherwise, intraday, again, let's pull it back in. Where's our Supertrend? Kind of screwed that one up, didn't I? Yeah, I kind of screwed that one. I lost that Supertrend in there. Let's go ahead and pull it up. Let's just use this one. 3, 10. Let's move all these. Yeah. Yeah, as I was saying earlier, it's just been a little sideways after that big run up on wheat yesterday. You just be chopping around, but you're not going to blow out. You're just kind of playing in the chop, but you're slowly going up. So if you're long wheat, short corn on a swing trade, you're okay. You're just not moving today. You're barely moving today. You didn't move much yesterday. The day before you made a big move, right? But you find these from stepping outside and go further away, and look at a higher time frame, just like anything else. As we discussed around here at this parity, these are areas where you want to be looking for longs. So there is longs in the inner market, in the inner markets. There's been some longs, been some longs, and you want to look at it like that. Obviously be a little harder to pin it down. You go on the daily, and you had some nice longs. Again, from parity levels, up. That's that. Another little pointers I want to give out to you is pull these things out on like a monthly, and you'll see where, your bottoms are at these zeros. You have this parity. That book I shared with some of you guys, that PDF, you want to find, so here's where market really is doing kind of what it needs to do. You have wheat versus corn here on a monthly chart. So is this going to date back to like 1970? And you got these zones when we get down into parity levels, parity level. Okay. You're going to have about a good 30-point, full carry areas. They'd call them minus 29, minus 30. Very typical and kind of like this kind of intermarket kind of a situation here on pricing. So, you risk 29 points, but you're on a swing trade where you're risking 29 points to make like 200 points. Okay. $50 a point. These are these kind of swings. This is our abnormality. We had in the 2007 markets crash or whatever, and here was our little Ukraine incident. But again, we went half of that ever extreme. If economies crash and stuff, what we're going to be looking at is these extremes again, right? Inflation and all that related. So, places to have looked long term to buy was like, the summer of last year. You had a great place to go long. Again, people say there's no opportunities for longs. It's just the way that they're looking at and what they're looking at. This is an expensive trade kind of to hold For a smaller trader, for a mid account, you can do it. You can get away with maybe a 10, but you're risking higher percentage than anything. I mean, we're not talking risk management percentages. I keep that out the picture. That's everyone's business. But if you're risking 30 handles to make 200 in a 10 grand account, it's a good trade, but it's not. It could have different definitions when it comes to risk. And I'm not one of those guys to talk about that. So, but as a trade, as a speculator point of view, these spreads are really great rotations. You might be looking, if things stay normal, you might be looking at shorts here at the 167s, possibly 220. I had friends that have come in this business, only traded this, never traded any product before, and caught a top of one of these few summers ago. So again, where do you get destroyed? You get destroyed if there's anything suddenly, but how many times is that happening in the course of your trading career on a spread? How many times is that happening? Things usually stay in line. If there's anything hectic, you bail out. And that's it. And you just re-enter when that time comes. That's the thing about spreads. They take a lot of patience. They're really intended for swing trades. But again, because they're intermarket, they can usually separate and make some funny moves, long, rotations intraday. So now we're looking at a 5-minute, breaking it down for all of February here. You can play, see if I can do these zones, kind of do it like everyone else here. Something like this, whatever. I got my boxes defaulted to a green color with the mid in between them. There's a reason of that. But, we can see here where this was, about a, 10 points, probably stop run, believe it or not. Or just if you look further back, but there's good enough rotations here, and these are shorter swings, right? So if you come here, swing trade this, or you come in intraday and the timing just falls at the time you're up and at your desk waiting to work, you might want to just short a week contract and buy, a corn. Don't forget, you're not going to have all day to get this move. And this is where some of these spreads just, for intraday don't work. I mean, they'll make you a few $100. But if you're one of those kind of cats that you want to make a lot every day, now you're looking at most likely that's not going to be doable because the time that you're going to have to bail out of that market. Here's another deal. Where are we right now? Look, where are we right now, price-wise, right? So, we've made, actually, this is a very big move. So, look, we've made since Tuesday. Wheat has gone up. And I think, again, this is relative to the fact that corn has done nothing. And now it pulls back and it makes another run up. We're looking at many days of wheat being stronger than corn. What could we possibly be looking for in this next business day or two coming up? Also, are we looking at the calendar to make sure we're not getting in on a day where there is WASD? That's the biggest thing in grains you want to watch out for if you're in them. Now, we've been in them and survived them and laughed, but it only takes one time, and then from then you learn. Don't ever be in that trade around that time. The liquidity gets thin on both of these markets. Everything gets flattened out and algos pull, and what'll happen is you'll get swung around 10 to 20 handles within like 10 seconds. Okay, so we're looking like we're going to test a spot, probably blow on up, and then maybe come back down. And in this particular micro time frame of this spread, that's what we're looking at that for short-term traders. Again, so long-term traders, hey, you're almost there. Let's go on a weekly, good potential place. You might see high probability shorts, or it blows over and you get a second chance up in the 230s, 250s range. This is the wheat corn spread. It's a pretty interesting one. It is pretty pricey, again, like I said, because it can move, its swings move at 50 a point. But the thing is, remember, if you catch the edges, your RR turns out really magnificent. You're looking at like 10 Rs, 15 Rs, things like this. Okay?